Picture this. It's mid-January 2026. Stocks are still riding high off last year's gains. Everyone's talking about AI changing the world forever. And yet, something feels off. Consumer confidence is dipping, layoffs are creeping up in certain sectors, and the big question on everyone's mind is, are we heading for a full-blown global recession this year? Or is this just another bumpy ride we'll cruise through? From where I sit, watching these cycles play out, 2026 looks like a year of steady but fragile growth. Not a blow-up disaster like 2008, but definitely not smooth sailing either. The pros at places like Goldman Sachs are calling for sturdy global growth around 2.8%, with the US potentially outperforming at 2.6% thanks to some fiscal boosts and easier money. JP Morgan's putting recession odds at about 35% for the US and globally, down from higher fears last year, but still meaningful. The IMF's more optimistic at 3.1% worldwide. Bottom line, most forecasts say we avoid a deep downturn, but the risks are real, and the weak spots are showing. So where's the ice thinnest right now? Let's break down the spots that feel most vulnerable. And yeah, history's giving us some clear warning signs from past blowups. First big one, the AI hype train. Companies have dumped massive cash into data centers, chips, and all things AI, treating it like the next internet revolution. It's powered a lot of growth lately. Some estimates say AI-related spending juiced US GDP big time in 2025. But what if the returns don't match the excitement? What if earnings growth stalls because the tech isn't monetizing fast enough yet? This screams dot-com bubble vibes from 2000. Back then, everyone poured money into internet stocks on wild promises, valuations went nuts, and when profits didn't show up quick enough, the whole thing popped. Nasdaq crashed over 75%, we slipped into recession, and it took years to recover. Right now, AI stocks are stretched, with some folks, even Alphabet's boss, warning of bubble risks. If investment spending slows in 2026, say, because debt gets too expensive or results lag, it could drag down tech, hit jobs in related sectors, and cool consumer spending fast. That's one of the biggest thin spots that could tip us over. Next up, tariffs and trade wars. With the new policies in full swing, higher costs on imports are already biting supply chains. We've seen rising layoffs in manufacturing, transportation, and AG double the rate from earlier last year. Per some surveys, businesses are holding off on investments because of all the uncertainty. Sound familiar? Think Smoot-Hawley in the 1930s. Those tariffs were supposed to protect American jobs, but they sparked retaliation, choked global trade, and turned a bad downturn into the Great Depression. Today's version isn't quite that extreme, yet. But if escalations continue, more reciprocal hits from China or Europe, it could shave 0.5 to 1% off global GDP, push inflation back up, and force the Fed to pause rate cuts or even hike. That makes everything pricier, slows home buying and business expansion, and risks a slowdown that feels like recession even if we technically avoid 2 negative quarters. Then there's the debt pileup. Governments and companies borrowed cheap during low-rate times, and now with rates higher, paying it back hurts more. Corporate debts at highs, especially in tech and real estate. Echoes of 2008 here. Banks lent like crazy on shaky mortgages, assuming prices only go up. When the bubble burst, credit froze, banks failed, recession hit hard. If growth cools and defaults rise, China's property woes could amplify this globally. We get a credit crunch that spreads fast. The next crisis trigger? Probably a combo. AI spending deceleration plus tariff shocks plus maybe a geopolitical oil spike or Middle East flare-up pushing energy prices higher. That could reignite inflation, already sticky around 2.5 to 3%, force tighter policy, and tank confidence. Labor markets flashing yellow, 2 job growths the weakest outside a recession in years. Unemployment ticking toward 4.5%. If it crosses 5%, spending drops and we're in trouble. Looking ahead through 2026 financially, early months might see a pop from fiscal perks or stimulus stocks. especially defense/energy, could rally on headlines. But mid-year onward, if tariffs really bite and AI hype cools, inflation sticks, Fed holds rates around 3.5% plus, mortgages stay 6 to 7%. S&P might test new highs if AI delivers, but a 10 to 20% pullback's realistic on any bubble fears. Bonds rally as safe havens. Yields drop if recession talk grows. Globally, places like India dodge hits better. China-tied spots suffer. By year-end, soft landing with 2 to 3% growth if we navigate well, or 15 to 25% stock drop and 5% unemployment if it goes south. My take? We're not doomed to a monster recession, but those old mistakes, overhyping tech, loading up debt, messing with trade, are waving red flags again. History says ignoring them bites hard. Diversify, don't chase pure AI hype. Keep some dry powder for volatility, and watch those labor and inflation numbers like a hawk.